Welcome, curious minds, to another deep dive. Today we're cutting through the noise to bring you a really fascinating look at Intuitive Machines, Inc. That's ticker LUNR, and their Q2 2025 earnings. Our mission, as always, is pretty clear. We're going beyond just the headlines, beyond the official performance data and market expectations to kind of reveal the deeper story behind those numbers. We'll be using our structured framework, integrating the company's own press release with real-time market data to paint, hopefully, a complete picture for you.
And that's exactly where the real value is, I think, because the headlines, they rarely tell the whole story. Understanding the full context, especially in a dynamic sector like, space exploration, it's just crucial. Got this framework we're using, it's really designed to help you find those aha moments, guiding you to a much clearer understanding of where a company truly stands, maybe beyond what you just see on the surface.
Couldn't agree more. So let's kick things off then. Now for slide one, the at-a-glance scorecard. Okay, so Intuitive Machines Q2 2025 results, they present a really complex, almost paradoxical picture. On one hand, you see some strong signs like top-line growth, but then there's this pretty significant miss of market expectations and a sharp reversal in bottom-line profitability compared to last year. And the market definitely noticed. Their stock fell, 4.76% in pre-market trading? That reflects some immediate investor concern, right? So what's actually going on here? Let's get into those headline figures. Looking at revenue versus estimate, yeah, it was a miss. The company reported total revenue of $50.31 million.
That fell a significant 26.5% below the consensus Wall Street estimate, which was sitting around $68.46 million. Then there's EPS versus estimate, also a miss. Now, the press release itself didn't give a GAAP or non-GAAP EPS figure, but market sources reported an adjusted EPS of negative 0.045 cents. That completely missed the consensus estimate, which was actually looking for a small profit, positive 0.01 cents. Analyst sentiment was pretty mixed initially.
You saw some noting the miss, issuing unfavorable ratings, while others were still bullish long-term, focused on the strategic positioning and future contracts. Now, here's what the numbers really start to tell, like a tale of two quarters. Let's talk year-over-year changes. Total revenue. It grew a healthy 20.9%, went from $41.6 million in Q2 last year to $50.3 million this quarter. Good top-line growth, right? But then you look at net income loss, and wow, it swung dramatically. Q2 2024, they actually had a profit, $18.5 million. Fast forward to Q2 2025, and it's a loss of $25.3 million. I mean, that's a huge minus 236.7% change. How do we square that circle? Strong revenue growth, but this massive swing to a loss?
Yeah, this is exactly the central tension of the quarter, and it's where, a casual glance might really misinterpret things. What's absolutely critical to understand here is that this sharp reversal in net income, it was not because their core business operations collapsed or demand suddenly weakened. It was primarily caused by non-operational, non-cash accounting items. Let me break that down. The prior year's $18.5 million profit. That included a substantial $44.2 million chunk labeled Other Income. Most of that came from positive changes in the fair value of warrants, basically options to buy stock, and also earnout liabilities. Think of earnouts as sort of deferred payments tied to future performance, maybe from acquisitions. These things can cause wild swings on paper, but they don't really reflect the day-to-day business. Then in Q2 2025, that same line item swung completely the other way to a $9.6 million expense. So yeah, that Q2 2024 profit wasn't really from core operations, and just comparing it directly to this quarter's loss without knowing that context, it's deeply misleading.
That's a really crucial distinction. Because, yeah, you see that net loss headline, and you might just assume the worst. Okay, so if the net income swing was mainly these accounting things, what about the revenue miss? Was that also not about weakening demand or project slowdowns?
Exactly right. Management was very explicit about it. They attributed the revenue shortfall to a strategic decision to align satellite delivery with Mission 3. CEO Steve Altemus clarified further that this meant bringing satellite manufacturing in-house. He emphasized this move was really to ensure, quote, performance, schedule clarity, and tight integration for their future missions. So yeah, this pivot to vertical integration, it did cause a delay in recognizing some revenue this specific quarter, but fundamentally, it's a long-term strategic investment. They're aiming for better control of the supply chain, quality, and ultimately capturing more value later on. It's a calculated choice, definitely not a sign of underlying weakness.
Moving to slide two, the engine of profitability. Okay, so we've covered the strategic plays and those accounting nuances that really shaped the headlines. Now let's turn our focus to the operational heart of the business, Intuitive Machines margins. What we see here is, well, despite continued operating losses, there seem to be some clear underlying efficiency improvements happening. Let's look at their gross loss for the quarter. The company's cost of revenue totaled $62.2 million, and that includes $6.1 million from affiliated companies. That actually exceeded their revenue of $50.3 million, so it resulted in a gross loss of $11.8 million, which translates to a gross margin of minus 23.5%.
Right, but what's fascinating here, and maybe a bit counterintuitive, is that while a negative gross margin isn't where you want to be long term, this actually marks a substantial improvement, about 15 percentage points better than the negative 38.5% gross margin they had back in Q2 2024. So this improvement at the gross level, it's a pretty strong signal they're getting better at managing costs on their core projects. It suggests they're becoming more effective, turning each dollar of revenue into gross profit, even if they're not quite in the black yet at that level. It points towards a positive trend in core ops.
Okay, so even though it's still negative, you're saying the direction of travel is actually positive operationally. Walk me through that a bit more. And moving down the P&L to their operating loss. For the quarter, that was $28.6 million, giving an operating margin of negative 56.9%.
That's right. And if we connect this to the bigger picture, this also represents a notable improvement from the negative 66.0% operating margin they had in the same quarter last year. Those efficiency gains we just talked about at the gross margin level, they were actually strong enough to more than offset a pretty hefty 45.5% year-over-year increase in G&A general and administrative expenses. G&A grew to $16.0 million. But look, that kind of increase in G&A is pretty typical for a company focused on growth. They're actively investing in infrastructure, expanding their team, building out capabilities for future projects. It's basically the cost of scaling up.
Makes sense. And what about adjusted EBITDA? That's a metric a lot of investors track for. Maybe a clearer picture of operational performance, stripping out some of that accounting noise we discussed earlier, right?
Absolutely. Adjusted EBITDA, it's a non-GAAP metric, and it tries to give a clearer view by adding back things like non-cash items and non-core stuff to the GAAP net loss. For Q2 2025, their adjusted EBITDA was a loss of $25.4 million. Now, that's actually nearly flat compared to the $25.1 million loss they reported in Q2 2024. The biggest adjustments they made were adding back a $13.0 million non-cash loss from that change in fair value of warrant liabilities we mentioned, and also about $2.5 million in non-cash share-based compensation expense. So this stability year over year, even though revenue grew significantly, it kind of raises an interesting question, doesn't it? What does it really tell us? Well, it underscores that the company is still very much in a heavy investment phase. Even with that 21% revenue jump, they haven't hit the scale they need for operational profitability yet. They're still pouring capital into building things out before the really big payouts.
Now for slide 3, financial strength and shareholder rewards. Okay, so we've looked at the headlines, the profitability engine. Now let's bring in the balance sheet, because for LUNR, you could argue this is its most significant strategic asset right now. It's really the financial foundation, letting them absorb these near-term operating losses while, aggressively pursuing their growth strategy. And they ended Q2 in an exceptionally strong liquidity position. I mean, a really robust $344.9 million in cash and cash equivalents. And crucially, zero debt. This isn't just a safety net, right? This cash position gives them effectively a multi-year runway at their current burn rate. It's a powerful tool for strategic moves, gives them a ton of flexibility. And if you look at their current asset to current liability ratio, total current assets, $396.8 million, covering total current liabilities of $107.3 million. That's a ratio of about 3.7 to 1. That indicates, ample capacity to meet all their short-term obligations without even breaking a sweat.
And you might see a line item on there like the total shareholders deficit is about negative $379.1 million. And you might wonder, what's that about? Oh, well, this really reflects the $347.7 million accumulated deficit. That comes from years and years of investment as a pre-profitability growth company. It's really important to clarify, this is not a sign of financial distress, especially when you look at that strong asset base and liquidity we just talked about. It's actually a common characteristic for companies investing super heavily for future growth before they hit consistent profitability. Think of it like the historical cost of building the whole rocket factory before you're launching rockets every single day.
Okay, that makes perfect sense. And speaking of financial strategy, I did notice something pretty interesting in their capital allocation, something that seems, a bit counterintuitive for an unprofitable company. Stock buybacks.
Yeah, what's fascinating here is exactly that. The company spent $20.7 million on repurchase of classic common stock, just in the first 6 months of 2025. Now, you're right, it might seem odd for a company that's not yet profitable to be buying back its own stock, but this action, It actually signals incredibly strong confidence from management. It strongly suggests they believe their stock is trading significantly below what they think its intrinsic value is. It's a capital allocation decision, basically saying management sees a potentially higher long-term return from buying back its own equity right now than from other possible investments. It's a pretty bold vote of confidence in their own future, I'd say.
That is a bold move for a company at this stage, essentially betting on themselves pretty heavily. How about free cash flow? Are they burning through that big cash pile quickly?
Well, their free cash flow, which is a non-GAAP measure, they define as cash from operations minus capital expenditures. It was negative for the first 6 months of the year. They actually generated a tiny bit of cash from operating activities, about $2.2 million. But they spent a significant $14.2 million on property and equipment. So that results in a free cash flow burn of about $14.2 million for the half year. And this really highlights the ongoing capital-intensive nature of what they're doing, expanding their production footprint, their operational capabilities. It's the cost of building out everything they need for those future missions, and it really shows why that huge cash pile is so absolutely vital to their whole strategy.
Now for slide 4, the road ahead management's outlook and key takeaways. All right, let's pivot now to what management themselves are saying, their commentary, and their forward-looking guidance. This quarter really seems to be framed by them as, a period of strategic investment, positioning the company for pretty substantial future growth. First off, their full-year 2025 revenue outlook. The company projects full-year revenue to be near the low end of prior outlook. Okay, that initially sounds maybe a bit disappointing. However, they also threw in that additional opportunities in the latter part of the year could potentially support revenue near the prior midpoint of $275 million. So that suggests some variability, maybe some potential upside later on. Regarding their path to profitability, management reiterated their long-term target. They stated they continue to expect positive adjusted EBITDA in 2026. That gives investors a pretty clear timeline, doesn't it, for when the company expects its core operations to actually start generating positive cash flow. And as for their overarching strategy, CEO Steve Altemus emphasized that two-pronged approach: internal investment, like bringing satellite manufacturing in-house, and then external acquisition, highlighted by that agreement to acquire KinetX, the space navigation software company. He also explicitly stated the company will remain opportunistic on further strategic M&A, particularly in data services and national security space markets.
Yeah, and then we can kind of connect this back to the bigger picture. These actions, they really outline a strong proactive vision for the future, don't they? Management's clearly making calculated decisions about where to invest, where to grow, even if it means some short-term market adjustments or, missing analyst numbers for a quarter. They're focused on building a stronger, more integrated company for the long haul.
So bringing all of this together then, what are the absolute key takeaways from this quarter? What should listeners really walk away with?
Okay, first, this was a strategic miss, not an operational failure, that Q2 revenue shortfall. It was a direct result of a calculated business decision vertically integrating satellite production. This isn't a sign of demand weakness. It's a strategic play prioritizing long-term control over their supply chain, their IP, future margins, even if it meant missing one quarter's forecast. Second key point, they have a fortress balance sheet that funds an offensive strategy. Nearly $345 million in cash, zero debt. That balance sheet is way more than just a defensive safety net. It's an offensive weapon. This financial muscle lets them absorb current losses while aggressively funding their M&A strategy, like we saw with the KinetX deal. They're clearly ready to buy, build, or partner. Third takeaway, it's a story of improving under the hood, but profitability is a 2026 story.
Yeah, despite the headline loss, those core profitability metrics, gross margin, operating margin, they showed real material improvement year over year. However, investors really need to align their expectations with management's very clear guidance. Positive adjusted EBITDA, that's a 2026 event, not 2025. So patience is definitely key here. And finally, number 4, they are pivoting to defensible, high-value markets. Management's commentary, their strategic actions, it all signals a clear focus on expanding into markets that are more defensible, potentially higher margin. Buying and navigation software firms, stating intent for data services and national security, it shows a strategy to build a more resilient, maybe more recurring revenue business model, moving beyond just purely mission delivery.
And this really raises, I think, an important question for you, the listener, to consider as an investor. What does this willingness to maybe disappoint Wall Street in the present? What does that tell us about management's long-term conviction? What does it say about their vision for potentially dominating the future commercial space economy? Are they playing chess while maybe others are playing checkers? Something to think about. Conclusion.
So what we really hope you take away from this deep dive today is how analyzing an earnings release with a consistent framework like the structured approach we used allows any investor really to move beyond just the headlines. It helps you identify those underlying performance drivers, assess a company's true financial health, and really get a handle on management's outlook based on their information, not just the market noise.
Right. And for your own research moving forward, maybe consider how those short-term market reactions often seem to overlook the strategic long-term investments that truly define where a company is headed. How can you maybe apply this kind of structured approach to discern genuine strategic shifts versus what might just be, temporary operational setbacks in your own portfolio or research?
Okay, before we wrap up, the necessary disclaimers. Please remember, this report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. All investment decisions should absolutely be made based on your own research and in consultation with a qualified financial professional. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities. And while we've made efforts to ensure accuracy, no guarantee is provided.
And just to be fully transparent, this report was generated by an artificial intelligence model. It integrated data directly from the company's official earnings press release, along with publicly available market data obtained via real-time web searches. Now, although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions, they might still occur. All information, especially financial data and calculations, should be independently verified by you before making any decisions based on it.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.